perfect. So what I've done is started the recording, and that means we are all ready to go with this presentation. Now, as you can see from what it says on the screen, what I want to talk to you about is the research that I've done, both in terms of analysis of spread betting traders, but also in terms of my own trading over a couple of decades. And I want to show you and share with you who wins and loses. Now, the reason for sharing this information is that a lot of people are actually quite unaware that there are some things they can do to improve their trading. But also, up until now, nobody's ever bothered to go behind the scenes at brokers, and then having done that, having started that at brokers, I want to also make sure everyone can see the screen there as well. As I say, this is the first time I'm using this. I want to make sure everyone can see the screen. Let me know if you can see the screen. And I want to make sure that you can all hear me. So just write that down, that you can actually see the screen and hear me, because then I will know that everything is correct. Yes, great, fine on the screen. Yes, all perfect. Good. Thank you. Sorry about that little scare there. I think we've got one or two people who can't, but that seems to be a problem at their end, not mine, because yes, there's a slide of me. Exactly correct, Chris. Thank you all very much. So let me just go into that again, where I was with this, which is that nobody up until now, up until what I'm about to show you, has bothered to go behind the scenes of a broker, go through all their clients over a number of years, look at the data, and work out who makes money and who loses, and what they have in common, and what we can learn from the winners, and what we can learn, obviously, from the losers. Now, I started this for a book in about 2004, 2005, and finished the research some 8 years later. The reason it took so long is because obviously you don't want to just rely on data from a week or a month. You want to rely on data spanning a number of years. But also, when there was a lot of data, when there was a lot of information, what you had to do was, of course, analyze it all. And that took time. What I want to do here is share findings from you from 3 different sources. First of all, private investors such as yourselves at spread betting firms, and show you and share with you who's been winning and who's been losing. That's the first thing. The second thing I want to share with you is research from the financial services industry in terms of who wins and who loses. And thirdly is to give you my own experiences as a trader, as a hedge fund manager, about who wins and who loses. That's 3 pretty impressive sources of information. I should pretty much have everything covered. And what I wanted to do in tonight's presentation was make sure you had information which was, as I do with all my webinars, original and insightful. I don't just want to repeat the same old stuff. So with that, let me kick off with the next screen. Now, I've got to give you the risk warning because this is serious stuff. I'm not just going to do it as a boilerplate. It's important. I'm sure you're all bored of seeing this, but I assure you I've met too many people who think they're going to get rich quick and lose a significant amount of money. So please do read and digest this risk warning that you can see on screen. Now, the next thing I'm going to show you is the disclaimer. And I've got to give the disclaimer to protect the people who are providing to trader, who are providing the services for this webinar, and of course my good self as well. So that's the disclaimer and the risk warning. The whole point of tonight's webinar is I'm hoping to mitigate your risk, reduce your risk, and of course, the most important thing is give you advice on how we can improve are trading, or more importantly, what winning traders do and what losing traders do, and so we can learn from that, what we can learn from them. In one sense, it's really straightforward. I'm going to break it down into three things, A, B, and C. And tonight's going to be broken down into these. Now, money management, trading system, and trading psychology, when we combine all three, that's where profits lie. That's all fine. That's all fine if we are talking in general terms, but we need to get into specifics. What is it? What specifically within money management? What specifically within trading systems? And what specifically within trading psychology is it that the winners were doing? So let me continue with that. I've shown you the risk warnings, I know already, but as I say, please take care with your investments. I'll move past this secondary repeat risk warning, as it were, and just give you a bit of background about myself, so that one of the most important things with any presentation is, okay, who's the messenger? Well, I've written 18 books for the Financial Times, amongst other publishers. This was one of my earlier ones, The Mind of a Trader, when I first wanted to get into trading. As you can see from the chairman of the Chicago Board of Trade, gets to the heart of the matter of trading by clearly elucidating the methodologies of successful trading, and that's what I want to get across to you today. I want to get across to you that the background I come from is we're not just picking out research or personal experiences, we're actually combining the research and the experiences of some of the world's greatest traders, and that's what, for instance, this book was. That's what I'm getting across today. It's been popular information, as high as number 5 on the Amazon bestseller list, above one of the Harry Potter books. I'm telling you this so that the information I give gets more readily imparted into your trading system and psychology. And of course, you'll be familiar with things like the TV programs and so on. And part of what I'm going to show you is what people like me did right when I won, for instance, the FT Financial Times competition. So this is from the Financial Times, who ranked me number 1 based on a competition to predict the FTSE 100, and that's my young-looking face back there. So all that information I want to put into here. Sorry, some of the images in uploading have changed in their formatting. There I can see. That's not something I was anticipating, but let me talk around it. I know what the screens say, thankfully. When I went through and analyzed thousands of trades over about just under 10 years worth of trading data, which I then put into a more recent book, one of the things which was key was amongst the winners and the losers was that the winners had found a way, and I'm going to show you some of the ways that they'd found to do this. The winners had found a way to avoid big losing trades. They didn't have the big losses. They just managed to dodge them one way or another. They had winners, and of winners, there were about 10 to 15% of a total trading population. They didn't have big losing trades. So we need to answer tonight, well, how was it? What were the techniques and strategies they used to avoid big losing trades? The other important thing was the losers and the winners look the same, except that the losers had some trades which basically wiped out an otherwise quite good record. So unlike what you might have expected, and what I actually expected, there wasn't a big difference between winners and losers. Now, that's actually good news for the rest of us, because what it means is there isn't a huge gap to switch from one to the other. What actually was the critical difference between the losing traders and the winning traders was that the winning traders avoided some big losses that would otherwise have wiped them out. And that was a critical factor in the difference between the two. One of the things that meant was that The winners were very disciplined. They had certain techniques, and I'm going to come across what these techniques are and get specific with you in a second. As I say, some of the images on screen you might be able to see as it's uploaded have moved off the formatting. I know one or two people can't see for some reason the screen, but I'm assuming everybody else can, which would suggest it might be a problem at their end. But I just want to make sure everyone still can see the screen. You should see a screen which says what top traders do. And one of the critical, so let me run you through some of these things. Those who took a systematic approach to their trading, when we interviewed and asked the ones who were winning what they were doing compared to what they were the ones who were losing, those who took a systematic approach tended to be the winners. The losers tend to be far more opportunistic, or they had so many different strategies they could not convey them. The winners tended to be very disciplined in focusing on one or two strategies, and that was it. So we're going to have to look at the kinds of strategies they might adopt, and I will go through some of those now. Also, one of the critical factors with winners was when they won, they tended to win more than what they lost. In other words, and I'll explain this and I'll show it in a chart going forward. This is just a summary of some of the findings before I delve into far more detail so that you can apply it yourself. The average win was bigger than the average loss. Now, what's interesting here is that it's a different way of saying the winners let their profits run. So we need to know how did they do that, and they cut those losses short. It's a flip side of saying that the winners didn't have big losses, which is what kept their average losses low. But it also meant that their average losses were lower because they had techniques for working out which trades were going to work and which weren't. And they also had a technique, which I'll talk about as we go forward, to ensure that when they were winning, they ran with those winners. So I will go into more detail with all of this. The surprising factor, one of the things that surprised me the most, though actually perhaps it shouldn't be so surprising because it's also true with my own trading, is that the proportion of winning trades to losing trades for the winners was about 55 to 45 to about 60 to 40. In other words, the winners weren't right 90% of the time. They were right about 55% of the time. They were only marginally better than a coin toss. What they were good at, however, is making sure that when they were wrong, the losses were quite small, and working out which trades were not going to be winners, and when they were right and got into a good trade, how to maximize those returns. And those are the things I will discuss as we go forward. And that was fascinating for me because, funnily enough, because it was around the time I'd already set up my hedge fund, and I knew that in the hedge fund industry, these were the things that the professional hedge fund traders did. So what was very surprising was that the 10 to 15% of winning spread betting traders were actually doing the same things that professional hedge fund managers do. Well, of course, I shouldn't have been surprised. But what was interesting is they did it without any kind of formal training. Now, to some extent, again, I shouldn't have been surprised because hedge fund managers such as myself, we don't have a formal training course on trading. We are taught it through our peers, through interviews, through meeting other hedge fund managers, through learning about trading in the way I'm teaching you now. There isn't an A-level in trading or a university degree in trading. So perhaps I shouldn't have been surprised. But what was interesting was that you could just be a regular person doing the same things that a professional hedge fund manager does. So I'll repeat and go back into these in detail as we move forward. But the winners were only right often 55% of the time. The most surprising statistic we saw was one individual who was right only 40% of the time, but was a winner, was profitable year on year, because he was making so much from those 40% of those trades that they overcame the losses from 60% of the losing trades. So we need to ask, how do they do it that they have these characteristics, and what can we do to copy or improve our own trading? So, moving on in that theme, Forex traders happen to be in our analysis particularly successful. Now, we're trying to work out why this is. It might be that foreign exchange is very liquid, that the trends tend to be quite linear, and then, of course, things move in narrow bands. It might be that the Forex traders, I don't know, had a higher IQ. I don't think that's something we could hypothesize, but anyway, we found that the Forex traders were particularly successful, and I've often heard it said by professional hedge fund managers as well when I interviewed them for my various books, that actually Forex they find a lot easier, or the futures markets generally, the liquid markets rather than equities, to apply the principles of things like technical analysis and trading actively. So that was something worth bearing in mind. Those who bet small amounts but did more trades tended to do better than those trading big but infrequently. So what we found was that the winning traders tended to bet small amounts but do it often. This was part of their risk mitigation. They tended just to trade relatively small amounts, dip in, is it going to be a winner, is it going to be a loser? If it's a winner, then they plow in more. If it's a loser, they cut it out and get out, rather than bet all their money on just one or two trades. Now, I could have said the opposite. I mean, I didn't know until I saw the data, because it could have been that I could have said, well, you know, the most successful, richest traders were the ones who just bet a large sum of money on one or two trades and got it right. That wasn't the case. So, and the other aspect was long trades, and you'll know this already, took longer to make money than short trades. In other words, as is often said, the short side of the market has very little company, is one way of putting it. Long trades took longer. Now, that doesn't mean that we should only look at shorting. What it does mean is we ought to have that in our armory, because return on our time will be that much greater. And it's, of course, just doing the opposite of going long very often. But given that winners who were shorting the market were making money quicker shorting than on their long trades, and speed is, of course, well, time is money, let's just put it that way, that's important. So, what do top traders know? What were the other characteristics? One of the things that we found was that once a position had risen 10% into profit, if it fell back into loss, it was highly unlikely thereafter to make money. Now, this is when we're really data mining sort of the big data stuff and looking at the characteristics of individual trades and seeing what was it that was in common. Is there something we could point at? Are there patterns we could point to and say, you know what, if this happens, then we know we're going to make money if this doesn't. One of the things that we found is if something had gone 10% into profit and then fallen back into a loss, a position, your overall position, then it was time to exit. Don't hold on. In other words, when we did a distribution of returns versus time versus profitability, we found that whenever something went from 10% profit back into a loss, the probability of it going back into profit diminished as each period, as each day, depending on the time frame chosen, increased. If it was 5 minutes that they were trading on 5-minute bars, then as each 5 minutes increased, the probabilities decreased. So that was very important to us to know. Now, in a way, it's another way of saying cut your losses, because losses often hold up good capital, which could be earning money. It's another way of saying that psychologically, people who are too afraid to face losses and therefore cut their losses and hold on to losing trades weren't the winners. They weren't successful. They fought that desire to hold on to losses because they wanted to maximize their number of wins. They avoided that. They knew it was all about profits, not about the number of wins. As I said earlier, we found that some people made money even if they were right 4 times out of 10. That's another way of saying the same thing. they were able to cut out a lot of losses at very small sizes because they were focused only in getting the winning trades. Sometimes I use the football analogy, and I know there's a lot of I can see from the names of people here, there's a lot of men on the webinar, and football tends to be overwhelmingly a male sport. So if I give a male analogy, it's like kicking the ball upfield to Wayne Rooney. 90% of the kicks upfield are not going to convert into a win. Doesn't matter. It's the 10% that matters. But it's that ability of a professional footballer. If you haven't seen them, they save their energy. They don't run after every one. They'll play the odds. They'll only go for the kill on the 2 or 3 shots which are going to make. So let me translate that again into trading. What it meant was a lot of people, a lot of the winners were more than happy to have a large number of losing trades as long as there were small losses, because they knew, this hasn't gone the way I thought. It's not running away. Fine, I'm not going to give it more time. I'm cutting it. This one's going my way. Great, I'll add to that position. I will add to the winners. It was one of the ways in which they increased their average wins by adding to a winning position when the trend was in their favor, rather than betting big initially. And what they did, a little bit like poker, they knew that a small bet is what you start off with. And then you might increase as you see the odds in your favor, as opposed to losers who tended to just start betting big from day one, right from the first trade. Okay, what else? Well, losers did this. What they tended to do, which was trades which turned out to be losses, were held longer by losers than by winners. Again, it's another way of saying that the winners tended to cut their losses very quickly. Losers tended to hold on average to losing trades for longer than their average holding period across all trades, and longer than the average holding period for all trades by winners. In other words, the longer you're sitting on a losing position, the more you should be assured that the odds are against you it's going to turn. Winners tended to hold on to losing positions for shorter time frames. They sort of knew that it's losing, it's not going in my direction, get rid of it before I lose more precious money. You see, what winners were focused on was profits. What losers were focused on is their emotions, how they would feel, as opposed to making money. Now, some more of this data before I get into specific strategies that they used and techniques that they use. Top traders knew, winning traders knew when something was likely to be a loser. Let me explain this. 90% of trades for winners made as much as they lost. In other words, if you took all the trades that winners made, 90% of their trades made a bit, lost a bit. It was the remaining 10% of the trades where they made their money. They had a few big winning trades. Now remember I said winners did not have any big losing trades, but they did have a few big winning trades. Of course, we'd all like only big winning trades, but life isn't like that. What winners had in common is they had some losing, some winning. Small winning trades, small losing trades. No big losing trades, but a few big winning trades. So how do you find those big winning trades? Well, the way they did it is they traded quite a lot, but they cut the losses short. And when they found a trade going in their favor, they added to the position. That's how it became bigger. It didn't just become bigger because it was moving in their direction. It became bigger because once it was in their favor, they started adding to that position. I'll speak a bit more about money management and how you judge how much to add, how much to bet later. One of the other things that was critical was none of this was based on the amount of money that they saw themselves winning. Their trade sizes were very critically based upon a stop loss where they knew they were going to be out. They also had an idea that, right, I'm making money here, so I'll add more and I'll make sure if I lose, I don't lose more than a very small percentage of my overall trading portfolio. And again, I'll go into figures in a second. As I said, losers held on longer than average once they knew they had a loser. So even once they had a losing trade, losers held on longer than the average number of periods they did for winning trades, which should have told them something. If my winning trades on average tend to be 10 days, and I'm holding on to something for 20 days and it's still losing money, it gives me a pretty good idea. Okay? Now, when were profits made? Well, I said Forex. I'm going to cover not just foreign exchange in this webinar, but more things than that. So I said quite a few made it in Forex. So let's look at that. When are the profits made? These are the average Pip movements during various foreign exchange time periods. So when Tokyo's open, when London's open, when New York's open. You'll notice the biggest Pip movements, and Pip movements are essential for making profits, are during London hours. That's good news for us. The reason I mention this is some people seem to think, oh, when it's a quiet market, that's when we should trade in the middle of the night. Well, actually, it suggests the biggest Pip movements are during the London period. So I wanted to show you this data. And what it shows is the average Pip movement of major currency pairs during each trading session. So you'll see, for instance, with sterling dollar, 127 Pip movements is the average Pip movement during the London trading period. Okay, so that being the case, let's move on. Which currencies should we be looking to trade then? This is sourced from a major US broker. Remember I said I've got data from my own, looking behind under the hood from brokerages myself, and also from industry sources. This is from an industry source, a major US broker. Now, let me take you through this. In blue, you'll see the percentage of winning trades by currency. Well, guess what? And it's a surprise to me, but those who traded the Australian dollar against the New Zealand dollar tended to be right 71% of the time. I'm not saying you'll be the same, but it's worth knowing, isn't it, that that was the easiest one to get right. Australian dollar versus Japanese yen, only right 49% of the time. Okay, what about some of the more popular ones? Euro, sterling, 58% of the time. That's not bad. Euro dollar, 59%, about the same. If that's, and cable, 64%. Notice something very important. Notice something very important. People were right more often than they were wrong in this. Yet, they weren't profitable. Overall, the vast majority of these weren't profitable. How could you be right more often, i.e. 64% of the time, be right on cable on sterling dollar, but at the same time be losing money? That's because the vast majority of people were losing more when they lost than winning when they won. That was the fundamental problem. So how do we stop that? I'll come to that in a second. But that's an important thing to know, that you can be right, and a lot of people chase being right, Australian dollar, New Zealand dollar, but in actual fact end up losing money. So that being the case, what we want to know is, well, what were they doing that was so right then? Well, I'll come to that. Which currencies were the most profitable then for people? Now look at this. Average profit is in blue, average loss is in red. Now it doesn't look so promising, does it? How is it that people, on average, were losing twice as much as they were winning? Now, how do we make sure we don't make that mistake? And which were the currencies which offered them the best odds? Well, actually, Australian dollar, Japanese yen was the closest to making sure that you overall were profitable. Look at some of the worst for retail investors. Euro dollar, and cable. So, contrary to the last chart where it suggested that you were hardly ever right trading Australian dollar, Japanese yen, this one says you might not hardly ever be right, but you'll make more money, and it's making money that's more important than winning. What I wanted to show you with these two charts is the difference between making money and being right. We want to make money, even if we're right, only 49% of the time. So if you want to make profits in foreign exchange trading, what I would say is be very careful with sterling dollar and euro dollar, all the popular ones. Have a look there with Australian dollar, Japanese yen. Unusually. It's what the statistics suggest. But I also want to tell you and teach you, how is it that if you're only right 50% of the time, you can still make money by making sure you don't have any big losses and you have winners which are big. That's what we're leading to. That's what we're moving on to. I happen to like sterling dollar. Why? Well, again, source from a major US broker, the profitability by time frame of the top 5 traded pairs Eastern time, that's in the US, it's minus 5 hours from now. And it shows profitability by time frame. And you will notice that sterling dollar by time frame, across all time frames, tended to have the greatest profitability percentages. And the worst, you can see, came from euro dollar, down here slumping quite a bit. Now, there's a lot of information to take in there, I know. The bottom line I take from it is actually don't just bin sterling dollar on the basis that a lot of losers lose a lot of money in it. It's still worth looking at, because the odds are in your favor of winning. All you've got to do is make sure when you win more than when you lose. And that's what we're going to move on to. How do we make sure we win more when we win than when we lose? By the way, I'm often asked, are you more likely to succeed with a $10,000 account than a $1,000? Now, this is the percentage of profitable traders and the percentage of their profits based on their account size. And you'll notice, yes, if you had more than $5,000, you had a slightly larger percentage, 37% of trades were profitable. This is across not just Forex, as opposed to 33% if you only started with $1,000 to $499,000. Now, there could be all sorts of explanations why it's better. The statistics don't look great anyway if you're only getting under 40% of trades which are profitable, but it shows you that it's probably better to have more than $5,000. Obviously, if you've got even more, the more money you've got, the better. That goes without saying, because you'll manage your costs will be a lower proportion. But I'd probably say got to be very careful with under $5,000, which is £3,000, because the costs, the spreads could eat into it. It's not to say don't do it. It's just to say, take care. What I would say is the time to use less than $5,000 is when you're practicing and learning. Don't start with large sums. You start with small sums, and you're practicing and learning. Use it as an education fund to teach yourself. Okay? So, let's just talk about making money and this issue about win-loss ratios. Now remember, if you are right 50% of the time, you're about as good as a coin. Okay? If you're right less than that, well, you still have a system. Systems just do the opposite. Nobody's going to be right 100% of the time other than God. So how often should we expect to be right? Well, as I said earlier, some winners were profitable, even though they were right only 4 times out of 10. But the vast majority were only right about the winners, were only right 6 times out of 10. Actually, the vast majority of losers were also often right only 6 times out of 10, but they just lost too big a size. So what's important here comes back to the same thing. Don't worry if you're only right 6 times out of 10. What we've got to focus on is not being right all the time, because the losers had something in common. They wanted to be right more than 6 times out of 10, so they'd hold on to their trades, hold on, and have big losses. The winners didn't care about being right 6 times out of 10 or 4 times out of 10. They cut those losses when they felt the trade wasn't working for them and wasn't likely to be a winner. Do you see that subtle distinction? And I told you the difference between winner and loser is very small. I mean, look, you've just seen the Winter Olympics. The difference between first and last, a winner and a loser, in many sports is under a second. So we shouldn't be surprised that the distinction isn't that big. We just got to tweak things a little bit. A marginal gain, huge benefits. So I'm going to go into what are those marginal gains for huge benefits. Let me explain this in a different way. You know, if you want to be 100% correct, it's easy. Don't ever exit a losing trade. I don't recommend it, because what then happens is all your losing trades are kept open and they're like an iceberg. They're getting bigger and bigger and bigger. But you can always say, oh, I only exit my winning trades. I'm 100% right all the time on my closing trades. But that's cheating. It's not true. Your profits above the waterline are small and look impressive because you're only ever closing winning trades. But you're not telling everybody what's happening underneath, all the ones you keep open, which are getting worse and worse and worse. And every single trading scandal that's happening underneath, all the ones you keep open, which are getting worse and worse and worse. And every single trading scandal that's ever happened in history has been a story of this. Okay? So how do we avoid that problem of having big losers? Now that we've come to terms with the fact that we can make money being right only 4 times out of 10 or 6 times out of 10, as we saw, winners could do that. How do we avoid having big losers? Well, this is what actually happens to most traders. They're watching CNBC in the background, they've got their coffee, and they're going like the clappers. Emotion, emotion, emotion. So let me talk a bit about it. The winners were very good at understanding emotion. And they understood this chart. That trades often started off with doubt and suspicion, became caution, then confidence, enthusiasm. That's the point at which losers bought. Then became greed, indifference, denial, concern, fear, panic, and that's the point at which losers sold. So losers lost money. Winners were better at controlling that because they were systematic, not opportunistic. And their systems told them, now I get in, now I get out. Something looks like a loss, I don't hold on to it. Something looks like a winner, I add to it. Relatively simple approaches. Let me take a slight detour and go into the question of, well, how much can we earn then? How much were people earning? I took a typical example of a winner who was trying to capture 95 pips per week, trading the FTSE. Okay? And we looked at various time frames, and can we do this? Can somebody do this? What we did is looked at capturing 95 pips, which was, as I say, is a random number in one sense, but it was a realistic number for somebody who was trading full time. Okay? And then we said, well, forget this individual. Let's assume it's quite a normal person who's only right 50% of the time, so hasn't got a particularly good system, but that's fine. Let's assume they capture 3 times the average true range. So don't worry what that is for the moment. I'll come to it in a second. They capture 3 times when they're correct and lose 2 times the average, call it daily range, when they're wrong. Okay, so they make more when they win than when they lose. What would happen to them? How likely are they, and what time frame should they trade if they want to trade for a living? So this was the maths. If you traded 1 minute, the number of signals they got per week were typically only about 85. So let's assume 85 is the typical number of signals. You might say, well, no, Alper, surely if you're trading on a 1 minute bar chart, you can get thousands. Yes, but a lot of the signals will be bad, poor, they're not buy and sell signals, and so on. So on that, the points they were capturing, because they put a stop loss at 2 times the average true range, so 2 times the true range on a 1 minute became 3. So that was their loss. Yeah, how do I work that out? Because the average true range on a 1 minute FTSE is 1.5. 2 times that is 3. When they were wrong, they lost 3 pips. Points captured on wins per week, assuming they were only correct 50% of the time. Well, do the maths. It comes to 765. Points lost on losses per week, because remember, half of these 85 trades were losses, and they lost 3 pips. They lost 510 in a week. So the net points gained were 255. We did that across each time frame and worked out that actually if you wanted to capture 95 pips, you were probably looking at trading about the 5-minute chart. Okay, that's a problem for a lot of people because that means you're in front of the computer a lot. But here's what's interesting for many people, that even trading the 1 hour time frame, number of signals per week, not that many, but they were capturing quite a lot of points. Well, wait a minute, how do we get to 95 pips? How do we increase our trading and our profitability based on what I've just shown you there? I know it looks a bit complicated, I'll explain it. One way, of course, is to trade a shorter time frame. Yeah? If you want to increase your profitability with a particular system, increase the time frame. Now you might say, well, Abish, how do I do that? I've got a day job. Don't forget that, as you all are on a webinar now, after work, you've got markets which are 24 hours. I'm not encouraging people to trade more. What I'm encouraging people to do is look at capturing more pips, not by betting bigger and bigger amounts where you might blow up and lose all your money, but actually trading more frequently but with the same bet size. That's a more risk-prudent way of trading and making more money. Got it? How else do we find it? Well, yes, you could double your initial trading capital and capture more pips. But to do that, you've got to have more risk capital. But I just wanted to mention that, obviously, to round it off. There is another way. There's another way of doing it, which is to increase your risk per trade from 2 to 3%. Now, where did I get the numbers 2 and 3% from? I'll show you those in a second. But 2% means the amount of your total trading capital you could lose on any one trade when you're wrong. So I'll explain how we calculate it in a second. If you move that from risking 2% of your overall capital to 3%, then of course you can make more money. I'll show you how in a second. And this was a technique which some of the winners used when their capital size was low. What we did is we looked at the winners for the amount of capital they had in their accounts and how much they were risking on each trade. And we found that the winners who had less capital tended to have a very strict risk profile where they didn't have big losses, but they had slightly increased risk per trade. How does that work? I'll show you the exact figures in a second on screen of exactly how that works. So what I've said there to summarize is trading profits actually depend on trade frequency, trade capital, and trade risk. Well, trading capital we can't do much about. Trading frequency is something we often overlook, and trading risk we often overlook. Trading risk does not mean holding on to your losers. It means pulling out a stop loss a bit further out, but being well aware you're risking more capital in order to make a greater gain. I'll show you in a second. Source of trading profits, in summary before I move on, for the winners was obviously the discipline that I mentioned. Wasn't so much the win-losses, but their ability to run wins. It was their ability to trade more frequently. Of course, capital had something to do with it, but what was interesting was even those with less capital were winners, and their ability to cut losses. So what is this 2 to 3% thing I'm talking about? Most winners never risk more than 2 to 3% of their capital in any one trade. What does that mean? What do I mean by that? Okay, let me explain. Risk means how much you could lose if you are wrong. How do you pick when you are wrong? We'll come to that. In our example, 40 pips was how much we could lose. So let's say we picked an example where 40 pips was how much we could lose. That's the point at which we know we're wrong and we get out of the trade. They did a process where they said, right, if I lose 40 pips, I will only lose 2 to 3% of my total trading capital. My total trading capital might be £10,000. I'll only lose 2 to 3% of that if I am wrong in hitting those 40 pips. Why? Because they learned that preserving profits was key. You see, the winners had learned that even if they lost 5 times in a row, which is very, very possible, they would then only be down 10%. Being down 10% is fine. You can recover that. You make an 11% return, you've recovered your 10% loss. If you risk 10% per trade, which is what we found losers did because they were in such a hurry to make money, if you risk 10%, then after 5 losing trades, which as I said, you could throw 5 tails in a row, you were down 50%. Guess what? It's very difficult to recover 50% because with the remainder of your money, you've got to make 100% return. Forgive the error on that bit there, but other than that, it's all correct. If you're down 5%, you only need 5.3% to break even. If you're down 10%, so you go from 100 to 90, then you only need an 11.1% return on 90 to get back to 100. Once you're down 20%, wow, you need a 25% return. If you're down 25%, you need a 33% return. Warren Buffett doesn't do 33% returns. So you can see that what the winners had learned was this mathematical trick that losses become exponentially larger. So make sure you're never down 25%. How do you make sure you're never down 25%? You made sure that all your losses were small because you worked out the point at which you'd exit and you would never lose more than 2 to 3% of your overall portfolio size. So let's go through the numbers. Let me go through the numbers for you so you see what I'm talking about. 40 pip stop loss. Let's say their system told them or a support level told them 40 pips would be the stop loss. They then knew that should equal 2 to 3% of the risk capital. If their risk capital, for argument's sake, to keep the numbers simple, was £100,000, which is a lot of money, then 2% of that is £2,000. Therefore, 40 pips loss should equal £2,000. Yeah? So 1 pip should be £50. 1 lot is £10 per pip on a standard 100 to 1 leverage, let's say. So they knew how many lots they needed. Do you see how they work it out? They worked out, or if you're spread betting, of course, it's even easier. 40 pips equals 2,000. 1 pip is 50, so it's £50 a point. If you've got 100,000, if you've got £10,000, then it's £5 a point that you would bet if 40 pips was your stop loss. But remember what I said earlier. Winning traders, when they lost less than when they won. So if their losses were 40 pips, on average, when they won, they made more than 40 pips. How did they make sure they made more than 40 pips? In 2 ways. They ran their winners, so they added to their winning positions slowly and took those positions off very quickly as well. But also, they made sure that whatever analysis they did, it was likely to give them more than a 40 pip, or whatever their loss was, return. In other words, let me put it this way, they didn't risk 40 pips in order to try to make 10. That's what winners had in common. Losers were willing, in order to make 10 pips, to hold on to a trade and lose 100 pips. Nuts. Absolutely nuts. For all the mathematics and the reasons I've shown you already. So let's just have a look at that. I mean, this is the maths if you followed it earlier. If 40 pips was your stop loss and 2% risk per trade, then on let's say 20 take, you did 1 lot size. That's FX, but obviously with spread betting, it's even easier to do the maths. One of the critical factors that I want to get across to people is this. Trading is like any other business. The most important thing was the ability to stay alive by keeping those losses small, taking lots of shots at success, but making sure the losses were very, very small. Look at this. Michael Jordan missed over 300 important shots. You're going to make a lot of losing trades. It's not about the number of wins or the number of losses. It was about the ability to persist and cut those losses and keep them small. And it wasn't about comparing to what somebody else is doing. It was about just getting it right for yourself. Because trading actually is an act of entrepreneurship. And that's why I wanted to take this and show you this slide from entrepreneurship. In other words, their risk to reward, somebody's asked me a question about risk to reward, their risk, if it was 40 pips, their reward they would look for realistically had to be more than 40 pips. If it wasn't, it's not a trade worth doing. And they only risk 2 to 3% of their capital on those 40 pips, and that's how they calculated their position size. It was those subtle, clever things that we do in my hedge fund, that hedge fund managers around the world did when I wrote the book Mind of a Trader, that the winners did, that I interviewed in this. It's those things that I wanted to get across to you before I repeat the risk warning. Remember, it's a leveraged product. Might not be suitable for everybody. This is not a solicitation to invest and trade. It's a solicitation to educate yourself and learn more. It's about the education. Trust me, it is well worth it.